Good afternoon, everyone. I'm Russell Rivera, founder and president of Voice Wealth Management, and welcome back to yet another seminar webinar with Discuss with Russ. Our guest today is Ron Friedman, a certified public accountant and certified tax resolution specialist with over 20 years of experience helping individuals and businesses navigate complex tax issues. As the founder of the Tax Relief Pro, he has successfully resolved thousands of tax cases from payment arrangements to negotiating settlements with the IRS. Known for his clear, no nonsense approach, Ron is dedicated to educating taxpayers about their rights and guiding them to financial stability. And is the recently released this book, Don't Get Screwed by the IRS. Hopefully that's showing up the right way on the screen instead of reversed. But nonetheless, Ron, thanks for joining us.
Thanks for having me. Great to be here.
Obviously, you have a lot of experience dealing, right? We've talked about a lot of experience in dealing with the IRS and helping the clients who come to you, deal with their tax issues. Sometimes we see these tax resolution companies showing up on television, but and asking for their business through that way. But how do they end up with you in the first place, right? How do people find you, and why do they end up coming to you? What did they do wrong?
There are a couple of different ways that I could answer that, and I'm going to start with my own why. My own why is that I'll use a baseball analogy. How do you spell relief? Ron Friedman, CPA. Because it's relief that that the taxpayer experiences when I take care of their tax trouble. Case in point, I had someone recently called me up and they got a CP 2000 notice, which is essentially a document mismatch. And it's a proposed assessment. And people immediately off the cuff, right out of the gate, they want to amend, when the proper procedure is not to do that. And it took me a while to explain that to him, that this is just a document mismatch. And you have to make sure that the IRS has all the pertinent information for your return based on this document mismatch.
Right. So, right, like I mean, obviously we could talk about the forms that happen, but realistically, the question is, how does, sometimes it's negligence by the taxpayer. Sometimes it's an error, as it seems to be in the case that you just prescribed. But you know, what are the situations that lead potentially to people needing to reach out to someone like you, and how is that different from reaching out to someone like you if they get a notice that they're going to get an audit, for example?
So let's couch it in more palatable terms. There's a big difference between getting caught speeding 10 miles over the limit than 40 or 50 miles over the limit. Uh, One could argue that 40 or 50 or miles over the limit could be criminal. Okay, so that's in the case where someone uh, intentionally avoids paying tax. Okay, or where if someone just falls down, scrapes their knee, as in the case of this particular person, fell on hard times, got into a bad habit, and now is reaping the rewards of an IRS notice.
Gotcha. So is it often because somebody fell on hard times? Like, obviously you and I have professionally interacted on
Mhm.
people having these situations for many different reasons, right? Sometimes it's somebody didn't file the return on their behalf. Sometimes it's right. We get to the criminal cases that we're all aware of where somebody is intentionally avoiding income and not telling people about income for a very long time, and those people end up in jail. What are the types of scales of the people you're working with, and when do they know to come to someone like you?
Oftentimes they don't know because it's very akin to getting your hand caught in the cookie jar. There's an element of fear and shame associated with it that it's very hard to burden with someone about that, especially with the consequences that are so dire when they go on for 3, 4, 5, 6 years. But it reminds me of a case that I have right now where the taxpayer came to me. It's a fairly complicated corporate uh, tax resolution case, but the story behind it is very simple. Guy has another partner. They had their problems, led to some type of split. In addition to the fact, within the past 12 months, the taxpayer that came to me lost his mother, father, ex-wife, fiance, and nephew all in 1 year.
Not
So
great.
it's really easy to get knocked off the track. Um, and it all depends upon our own mettle and financial knowledge. And I love telling this story. When I used to have a Dodge Caravan, I thought I was such a big mocker, changing oils for my own cars. I was, that was the extent of the care that I put into my cars. When I thought that I could change the radiator fluid on my own, I didn't realize that Dodge and Chrysler only use Mopar parts, and you can't get, radiator fluid over the counter. So I wasted a whole day trying to flush and fill the radiator, and still had to take it to the mechanic anyway.
That is, I'm sure that was a frustrating experience. Just so everybody knows, we're sitting with Ron Friedman, CPA and tax resolution specialist, author of the book "Don't Get Screwed by the IRS," available on Amazon. Um, so let's take it back for a second, right? Because it's tax season. Most people will see it after the tax deadline of April 15th. Obviously there are people who come to you really dealing with significant tax underpayment, mispayment, non-payment issues over a period of years. But a lot of people are just afraid of that dreaded audit, right? That's the thing that people are most leery of. So in terms of trying to avoid audits, whether it's if they're late filing for 2026 or later in 2027, what are things people should know so that they can avoid having that happen?
There are two key things that need to happen because there's a truism at the IRS that they'll believe every taxpayer, they'll believe everything that they say, so long as it's wrapped in proof. And that proof has to be very specific. And then when it comes to deductions, those deductions have to basically sit on a three-legged stool. They have to have the purpose claimed for the deduction. They have to have proof of payment and an invoice for it. So, if you have those three elements for any business deduction or itemized deduction, you're golden.
I mean, obviously we've changed the environment in terms of you specifically mentioned business deduction. So this is really off of that in the sense that you have a lot of people, now so many things are done by credit card. And so like the idea of taking a taxi receipt or a receipt from the deli because you went to go pick up a meal when you went to go see a client, those things have changed, right? Has their standard of proof changed? Do you still have to go and ask the gas station attendant for the receipt the same way, or is the credit card the credit card charge sufficient, or do you need even additional documentation be above and beyond?
The answer to that is the phrase that every accountant loves to use until they have to start wearing them. It depends. So, um, the level of substantiation required for an audit falls under the audit guidelines of the IRS. I've seen them um, applied in such a way that I have to ask for a second set of eyes to review them. I'm going to appeals with them. So, um, like I said before, the stool of three P's. I have all this substantiation. The auditor decided not to accept certain substantiation for whatever reason. I have legal precedent and procedure that would tell her otherwise, because you can't accept something based on a arbitrary measure. I've given you the documents to prove.
Right. And so, obviously we've talked about, right, whether it's in the tax resolution process, and you mentioned it here, and also I guess through the auditing process, whichever that ends up being, right? You've talked about appealing. So again, sometimes some people don't hire someone like you in order to try to go through the initial steps of the process. And
Mhm.
then they were like, wait, I don't like what I got. Now they've got to appeal, or they want to appeal. What should
Mhm.
they do? How do they do that?
So the path to appeals is paved by procedure, and it all points to you got to how you got through the collection maze to get appeal rights. Okay. So in order to get collection due process rights, you have to be you have to answer a notice that either proposes to levy or lien you, or some other proposed IRS action. That opens the door to basically your day in court, your financial day in court, to propose a collection alternative that both parties can live up to.
So you mentioned two keywords, and I'm sure people have heard before, whether it's taxes or other things. What is the difference between a lien and a levy?
One's a piece of paper, one isn't. So, well, they are technically they both are, but they instruct the reader to do two different things. So, a lien is a piece of paper that is slapped on all of your property that you own and acquire after the issuance of the lien, that tells the world this piece of property can't be sold until we're paid. So, think of car, think of house, think of second house. Okay, if and so the liens most often come up in title searches when people are looking to change residences or sell second residences or transactions of that nature.
So does that mean that if, let's say, there is a lien on a piece of property, does that mean that the IRS or the taxing authority, whomever that might be, is the first beneficiary of the proceeds of the sale? Or does that mean you can't sell the property until?
To differentiate a lien from a levy is when the bank or or institution that the IRS is interested in, and they just take the stuff. They forcefully take either cash, retirement accounts, uh, um, uh, investment accounts, customer accounts. So if you're a person in business and I'm helping someone right now trying to get a levy released from her customers, okay, the IRS can insist. So for instance, my if I owe the IRS can go after my customers for the money that they say that I owe them.
Right. So again, so the lien is, hey, it's a note saying you can't sell it. The levy is
until
saying
until
until someone gets paid. Whereas the levy is saying, hey, we're gonna come
right now.
after, right. We're gonna take stuff from you now. So it's a time factor rather than, you know, something else. And that's different from a garnishment, because a garnishment is typically we're going to take your wages as they get paid until we get paid. So it's a little bit of a hybrid.
No, there are two different types of levies. There's a one-time levy and a continuous levy. A wage levy is a continuous levy.
Gotcha.
And so is Social Security for those people who owe taxes that might be in that economic strata where Social Security is their only income.
Well, that also makes it's easy to levy Social Security because, they're just paying themselves.
They can do it up to 100%.
Understood. Understood. Um, so when someone has some sort of issue, they recognize, hey, something went wrong, I didn't file my taxes for 2 years, or they weren't filed for me for 4 or 5 years, or something else. Obviously they should call you, but what should they come prepared to give you in order to help make this a little bit easier?
Well, for the first thing, it's the presumption that one can delegate the duty to file a return. That's something you cannot do. So to say that my accountant didn't file it is you're beating a dead horse. So in the cases where people don't file, they are required to file for a period of time that is preset by the IRS. So if you're delinquent for 10, 15, 20 years, and I've seen cases like that, IRS only wants 6 years of returns in order to deem you compliant.
So you've got to pay the last, or you've got to file for the last 6 years
File and pay for the last 6 years.
in order to be compliant. Anything else is, hey, past we'll call it statute of limitations for our conversation. That's what I'm used to from
Well,
the law and order world.
the assessment statute has been over for 3 years anyway, so who cares?
What do you mean by that? The assessment statute?
So if the IRS in its transcript record sees that a return that hasn't been filed that needs to be filed because uh, based on the limited deductions that would be given on a substitute for return, the IRS could collect from it. They create a substitute for return, which assesses a tax and sticks you with it for 10 years until you file your own.
And so they'll basically create a substitute for return for you until you file your own.
Right.
What are
Until you properly reconcile your income and your deductions, because when they file one for you, they will file it single, no exemptions, nothing, in order to collect the most amount of tax.
Okay, so they're going to make it so that as if you had no, if you didn't itemize your
Correct.
deductions,
Right.
as if you'd never made a charitable contribution,
As if your 1099 was all income and no expenses.
meaning like in what
So,
sense? From a
so, so,
1099 perspective. Go ahead.
so if you're a freelancer, if you imagine the difference between taxed on $90,000 or a net of 45 or 30.
Right, obviously, because there's no deductions that they're handling because you haven't done your Schedule C deductions.
Right.
Understood. So hence you get hit with the whole thing because you didn't file. They just know that they have a 1099, you got paid X, but you haven't provided any documentation of any of the expenses you had. So they're going to assume they get to get tax on 100% of your revenue for getting your costs. And then they're going to say, hey, demonstrate your costs, right? And file and demonstrate your costs.
Well, not only that, I mean, for a delinquent filer, the penalties are going to be assessed on the higher tax amount.
So
and
even
and
if you demonstrate
and
your costs, it doesn't really
well,
say as
until
much
you
as it
file
should.
until you file your return and demonstrate otherwise,
Mhm.
their numbers stick.
Well, that would make sense, right? But the idea is you'd have to file first, and then whatever that resolution process that you're the expert at figures out exactly what that amount should be after everything is filed properly.
Right.
And that's where people hire you for, is because they get to figure out in between, that the government comes up with their number and you have your number and here's your stuff, and you put it all together. Am I getting that right?
Well, in terms of compliance, it's just a matter of reporting what the government has and integrating that with what the reporting the taxpayer has. And that becomes a legally binding document when you file your return. It's signed under the penalties of perjury.
Right. Well, nobody wants to perjure themselves. I would hope.
That's why they call it a substitute for return.
Mhm.
Right? We don't know. We're guessing at this at their return. We have all the income. We don't know what else there is.
Right, because they're looking at it and saying we're substituting because we know your income, but it's up to the taxpayer to provide any deductions for the most part, right? There's very little. There might, I don't know what the government might know is a deduction, but let's even consider if there's like an earned income tax credit. They're not, the IRS wouldn't necessarily claim that for you, even though if your income level might qualify for it, I would assume, correct?
I just received a call the other day about a taxpayer who was unemployed during 2023 and fell into a bad gambling habit. His wife doesn't know about it, and all of a sudden gets an invitation to the party by the IRS. And I explained to him all it is just a proposal. And it was quite an interesting conversation because he realized that this was not a good way to spend my time because you know during that period in time when I was out of work, I was the recipient of certain government benefits. I don't want to pay them back.
And you're saying in terms of the taxpayer because he had the
He had gotten significant refunds for that year,
right.
and based on the assessment, not only would he have to pay the refunds back, but there would be tax and penalties on top of that.
Mhm. And you bring, because you brought up this situation, it made me think of something else that you wrote about in your book a little bit in depth. And it really has to do with dealing with couples, right? And that is the concept of the innocent spouse, right? And the
Right.
example you just gave, the husband was a gambler, and as a result didn't have money to pay tax, and obviously, as you write in your book and you and I have had separate conversations, under normal circumstance the wife is just as liable as the husband for the tax debt, except in cases of innocent spouse. So let's talk
Well,
about what that is.
in legal terms, there's a presumption of enjoying the fruits of the poison tree. Okay, for anyone that wants to claim innocent spouse, you have to prove that you had no knowledge or could not have known about the understatement of tax or underpayment of tax.
I
Okay,
mean,
or understatement of income. Sorry.
I'm sure there are plenty of people who could not have known. Um, but I see that as kind of a harder thing to prove. I know obviously you've provided one example that I read about, and maybe you'll want to go into that.
Yeah, I mean that was, I mean, in terms of being able to help an American taxpayer, it was a gem. It was a find. And I say that, with all humility because I wouldn't give the troubles that that woman suffered to a monkey on a rock. The pain that her husband caused to her and her family, it's hard for me to even talk about because it's horrible, just horrible. But what he did succeed in doing was leaving a bankrupt estate and leaving his widow with a lot of debt, and I was able to, get her out of it.
And right, and so what was the reason that she was able to get out of it? Because the estate was bankrupt, because she obviously didn't know what was going on. What were essentially the facts that mattered?
There were actually, you'd be interested in finding this, in understanding this, because there were elements of financial abuse that were perpetrated against the taxpayer. Um, the now deceased spouse was living a double life, with a girlfriend and supporting a girlfriend and the girlfriend's daughter, forging the taxpayer's name on documents. real
If there was
real nice.
forging, then she couldn't have known.
Yeah, real nice, upstanding citizen.
Sure. And this sounds like a wonderful, wonderful situation. Obviously, I say that with all sarcasm in the world. Um, so anything else you'd like to share about, the avoiding audits, tax resolution process, or anything else before we kind of go to questions from Lisa?
Representing taxpayers has really given me an education not only into the way the macroeconomic system works, but into human behavior. And some of the stories along the way help me sharpen the way I deliver my services because this is a difficult system to navigate. And it is certainly under, like any business, any collections agency has its ebbs and flows in terms of underwriting. And government needs money now. And they're not as forgiving as they may once have been. So I mean, if you've got a case, you need a strong advocate.
Very good. Thanks, Ron. Lisa, I know you're on the call right now. I wanted to know if you had any questions.
You have some amazing stories about individuals. Just curious what some of the big pitfalls you see are for small business owners.
Not much different because they're operated by humans. Business problems usually center around payroll, and they're usually centered around financial mismanagement.
And what does that mean in terms of financial mismanagement?
Most of the time, it's contractors, and since they operate on a retainer basis, the employees get paid first, not the taxes. And if there are cost overruns on a job, the taxes still don't get paid. And the snowball has begun.
So, in some sense, this goes exactly against that famous business book, Profits First. And so it basically tells you to pay yourself when you're realistically saying, regardless of anything else, even before you make your payroll, you got to pay your taxes first.
You know something? I have something to say about profits first. Make part of the profit part of your cost structure, then they'll always get paid. And I learned that from a mentor of mine who said to me, this firm is client number one. So if I integrate the costs of me into the firm, I'm a lot happier.
Gotcha. Interesting. All right. What's this doing? Sorry about that. Give me a second.
That's okay.
Any other questions, Lisa?
Um, just any thoughts about the contractor employee distinctions and if anything has changed in the past couple of years?
Be more specific.
Um, what are some things that would get a worker reclassified from contractor to employee in terms of honest mistakes that the owners are making when the owner is really thinking the person is truly a contractor?
The best thing to do is to have a a good onboarding process, understanding of delegation of duties, who does what, when, where, why, and how. So generally speaking, if someone operates like a plumber, they have a lot of different clients. That's easy to prove. That's the standard that should be used, because the plumber comes with his own tools, sets his own schedule, has his own knowledge base, and the only thing he needs is access to the workspace. It's all he needs. I did take a class over the summer about worker misclassification audits, but that's at the entity level.
That's going to do it for us here. Ron, I want to thank you for taking a half an hour of your time during your busy tax season
Thank you.
to do this. Again, Ron Friedman, CPA. The book is Don't Get Screwed by the IRS. You can take a look at that and order that on Amazon. And that is to make sure, if you do have any tax resolution issues, please consider giving Ron a call, and see how he might be able to help you out or anyone else you know. Again, I'm Russell Rivera, founder and president of Voice Wealth Management. Our next webinar will be on April 30th, talking about helping seniors avoid AI scams. We're going to have a nice panel for that. So I'd really love to have a lot of viewers for that one. With that, this is Russ Rivera for Discuss with Russ. I want to thank you for joining us and thank you for watching us, and we'll see you next time.